First, I know that unlike individual shares, you can effectively bet the FTSE 100 24/7 because in reality it's a 24-hour market. Comment about
that? Yes, it is a 24-hour a day market. There isn't much of the week where where something isn't open and something isn't available to trade. The FTSE, like any of the stock indices, because there is always something open, because there are currencies trading, because there are commodities trading, because there are always other stock indices trading, because obviously we have the different sort of financial centres around the world. There's no reason why you can't trade the FTSE, for instance, or the Dow, or whatever it might be, any of these indices, 24 hours, because we're all, to some extent, there is an interrelation between them. So that fine, why not? And if you are particularly keen on trading a particular index, it's great to have the ability to be able to trade in and out of that at any time, and not have that gap during the trading day where some event has happened overnight or whatever, and you have to wait for a specific time the next morning to be able to take any action. Indeed also the very fact that you can put a stop on your position and that market still be actively trading overnight means you're less likely to get that big gap. If something does happen untoward, you're less likely to have your stop filled at a much worse level because the market has gapped. And the spread bettors out there are charging you for the privilege of that because you have a wider spread. So that's great. So yes, I quite like the idea that you have that. I like the fact that we have this ability to trade these markets 24 hours.
Follow up, leaving aside any influence of the opening and closing auctions, if lots of big money, long bets are placed outside UK market hours by investment houses or hedge companies on the FTSE 100 to go higher,
right?
Does the weight of such bets move the FTSE up?
Okay, yeah, I've got it. Okay. Yes, I mean, if you have a weight of money channeling into the FTSE 100, and that would be via the futures, but it's not the only way. You can get a weighting to the FTSE 100, and institutions do. They don't necessarily need to go in and buy the futures market. They're perfectly capable because they have the systems available, and there are all kinds of different exchanges now. Remember, it's not just the London Stock Exchange. You've got all these sort of Chi-X or whatever it's called, and various sort of places where you can buy and sell stock. And so, these institutions can create their own portfolios, and they can create their own ways of trying to arbitrage the market and sort of add in swaps and all kinds of other stuff. So what I'm saying there is there is sort of there's enough money in the market, and the institutions are big enough to mean that if money, a weight of money is going into one thing, so the FTSE 100, and I'm assuming we're talking about the FTSE 100 futures here, there are all kinds of other ways that sort of, if differentials appear, which means that a particular stock, because of its particular weighting within the broader index, looks undervalued, then there's going to be someone who's going to pounce on that. There's going to be someone they're going to pick up on it, and yes, that stock or those stocks will go higher, will go up, and will be bought, and will end up, or they'll generally be bought, but they might be bid up in order that the FTSE futures and the underlying of the cash market will come back in line again.
So does that in turn mean that the price of an individual shares that comprise the FTSE will also rise as a result?
Yes, it does. I mean, this is the thing. I mean, we talk about the futures, for instance, being the tail that wags the dog. What that really means is that one trade on the FTSE futures, and you've got exposure to 100 individual stocks, the constituents of that FTSE. Okay. Well, you could go in and buy the individual constituents of the FTSE in the proportion that they exist in the FTSE. But it's a bigger thing to do, and I'm quite sure that it could be done sort of electronically a lot quicker than it used to be done in the old days. But it's still, there's one instant trade and there's one slightly longer trade to get the same overall effect. So the FTSE futures is the tail that wags the dog in that. It's much more easier to influence, and you get the swings that happen in the futures, which are not going to be immediately translated or seen in the underlying FTSE 100 index.
Indices cannot go broke, and high volume makes it easy to buy and sell. So can indices be considered a better investment to trade than shares?
Indices compared to shares. Well, I mean, there are some schools of thought on this one. I mean, I prefer indices because I'm sort of looking at a general overall trend. Is the market, is the market overvalued or undervalued or whatever? And I mean, with an index, you can do that very simply. And it's fast moving, especially, and if you're looking at sort of a smaller stock, for instance, you do sort of, it's quite hard sometimes to sort of look at a chart without seeing a lot of noise on it. I mean, I'm not talking about the big stocks now, HSBC, Vodafone, Microsoft, Google, whatever. Okay, those are big stocks where, the volumes and liquidity is such that you can get some, you can get sensible chart patterns, and you can sort of see what's going on. Looking at a smaller stock, something that's in the 250 or whatever, just because it's not traded particularly frequently or as frequently as a FTSE 100 stock or an index, means I find it harder to sort of discern chart patterns. And so, I would only be looking to sort of trade that stock if I felt that I knew something in particular that was going to happen, or whatever. That's why I would do that. And of course, I mean, the flip side is, of course, you can get it wrong, and the stock can go to zero. I remember doing that distinctly with some I can't even remember what it was called now, but it ran bars, so not bars, pubs, that kind of thing. And they just released a trading statement in September saying that business was absolutely brilliant, and I was along with it, and I was looking for, thought, well, here we go, we're getting into the Christmas period. And I think that a month later or something, they were bust, and that was it. And the stock was zero. So, what can you do about that? Now, if I'd sort of been taking a view on an index, of course, that wouldn't have mattered. But the flip side, of course, is that with stocks, you get what you call triple baggers. So in other words, you're not going to get an index which is going to quickly go from 6,000 to 18,000. But it's certainly possible for a stock which is £6 to go to 18 quid. And of course, that's what people are often looking for. The next Google, the next Microsoft.
The next Alibaba?
The next Alibaba.